The way that you spend money can actually save you money in retirement. I'm Tracy Capelman. It's all part of a tax plan to beat the tax man. Right now on Your Wealth Health. Hello and welcome to Your Wealth Health, a show focused on helping you manage your money. I'm your host, Tracy Capelman, and I'm here once again with the founder and CEO of Hilltop Wealth Solutions, Eric Brenner. Eric is a certified financial advisor with nearly 30 years of experience. He's written financial articles for national media outlets and appears on other local TV shows as a financial expert. We're going to continue with our series of shows designed to help you develop a tax plan to beat the tax man in retirement. And we're explaining how you can keep much more of your hard-earned money if you have a comprehensive tax strategy. Now, last week, we discussed Social Security and healthcare tax traps that you can avoid. This week, we want to focus on retirement accounts and other income sources. Eric, you're going to explain the best ways to use these different income sources, and I understand you have a case study to help people understand.
Yeah, I do. And before I do that, I just want to show this graphic that, you must plan on how and when you will use taxable, tax-deferred, and tax-free assets to manage your income in tax brackets effectively or efficiently. So let's talk about this case that we have. We have Sam and Mary, and Sam and Mary want to spend $8,500 per month in their retirement. And you can see that each of them have IRAs of approximately $450,000. They each have Roth IRAs of $60,000, and then they have a joint bank account of $300,000. So many people would think, well, which accounts do I spend first? Okay, do I spend my taxable money? Because guess what? If I take it out of my IRA, I know it's going to be taxed. That's what I've heard. So I'm going to spend my taxable money first. That's that account that's in their checking, savings, other accounts. And then spend my deferred money, which is my IRA money. That's money that has deferred, but has yet to be taxed because I had not withdrawn it. And then spend the tax exempt money last. Well, when you look at an alternative approach, we really look at spending taxable money, but also convert IRAs to Roths in the low tax years, because oftentimes if someone retires early, whether that's 60, 62, 65, they have this window, Tracy, between ages 59 and a half and 72. At 72, they have to start drawing out of their IRA, traditional IRA assets. So they got this window of opportunity, and really it looks at should they spend really the taxable amount, but also do some conversions. And then lastly is the conversion that we talked about. Should they do a conversion strategy? And so I know we're going to talk about that next.
Yeah, Eric, you have talked about Roth IRAs in past shows and why it could be a good strategy for people to convert to a Roth IRA. And it's really important right now because taxes are likely to go up, right?
Yeah, I think they are likely to go up. I mean, I think if you ask people, I know when I ask clients, do you think taxes are going to go up, go down, or stay the same? Pretty much unanimously, it's, they're going to go up. And so this example that I wanted to show was this Roth conversion. If we had someone that, Jill here has $100,000 from her IRA to her Roth, she's going to have to add $100,000 to her income. And then that conversion is going to be taxed at that Jill's rate. Well, Tracy, we often talk about filling up the bracket. So, we have these brackets in our tax system that is a very complex tax system. When you think about different streams of income are taxed differently. So if you look at this illustration, before conversion, she was in the 22% bracket, but you can see there in the bucket, the 22% bucket, it's not quite full. But after conversion, she's filling up the 22% bucket, but not going to the 24. So it's really, really key to see, are you utilizing your bracket? Okay. The other thing to think about is lower income years is good for Roth conversion. So some examples would be a business owner with unusually low sales, maybe a business owner with unusually high expenses, high non-recurring medical bills. I've had situations where somebody has a lot of medical bills, unfortunately, that helps them tax-wise, and they don't think about maybe doing some Roth conversions. And then after retirement, but before receiving Social Security benefits, pensions, and other income is another way that you can look at, or area you can look at in doing Roth conversions.
Filling the tax bracket. I want to remember that. That was a good phrase. One of this country's leading experts on Roth IRA conversions and general tax planning is Ed Slott. And he has a new book that we're making available to our viewers called The New Retirement Savings Time Bomb. It is described as a complete action plan to help you make sure your 401ks, IRAs, and retirement savings aren't depleted by taxes by the time you need to use them. Robert Powell of USA Today had this to say about the book. He says the insights you'll gain from reading this book will be invaluable. Eric, what more do people need to know about this book, and how can they get a free copy?
Yeah, this book, Ed Slott, who we have been affiliated with for several years, and our advisors are part of his elite advisor group. He's written several books. He's a CPA by trade, and you may have seen him on TV shows. He does a lot of public television and so forth. So we just think that this book was we waited for a while. He's written books before, but this book is something that really lays out, I think, in layman's terms, to try to avoid the tax bomb. And it's easy to get, Tracy. We're giving it away. It's free. All they have to do is just call the number or go to yourwealthhealth.com. They can get their copy. There's no strings attached. And we really want people to be well educated and take advantage of this offer.
It's free. Sign me up. That's awesome. Well, Hilltop has a great relationship with Ed Slott. He has appeared on this show, and all of your advisors are part of the Elite Advisors Group. Tell us a little bit about what that means.
Yeah, so this Elite Advisor Group, we're proud to be affiliated with it. You have to apply, and then you have to commit to continuing to educate yourselves and attending really two-day trainings every single year. So there's a little over 400 in this group, and there's more than 300 financial advisors. Or 300,000, excuse me, Tracy. So 300,000 financial advisors, 400 in the Elite Advisor Group. And so they're there to just help us make sure that we're up to date on laws, strategies, and really work with cases as we work with clients in guiding us to make sure we're giving them the best advice.
It sounds like it really sets you guys apart. We also wanted to discuss another strategy when it comes to tax planning, and that has to do with charitable giving. People can help others by giving to charity and at the same time help themselves with their taxes, but they have to do it the right way, right, Eric?
Yeah, they really do. And, Tracy, this is something that's overlooked a lot. It's called a qualified charitable distribution. And at 70 and a half, somebody that has IRA money can actually utilize this strategy. And so this is a true case that this person came to me as a new client and didn't really realize that they could do this strategy. So the client was 81. You can see that they gave $10,000 a year to charity. So really charitably inclined. Okay. That $10,000 satisfied their required minimum distribution. And the tax bill on taking that out was about $2,200. So the total cost for the $10,000 plus the tax was a little over $12,000. And he'd been doing this since 2010. So total contributions to the charity of $100,000 and paid more than $22,000 in taxes. Well, if you look, Tracy, at really the strategy, and he was working with another advisor, and the advisor never talked to him about this. And so by doing a qualified charitable distribution, the $10,000 still goes to the charity. The $10,000 is excluded from taxable income, and it also satisfies the required minimum distribution. So he saved and is saving over $2,200 a year. Now, if he would have started doing this back when he could have done it, that would have been over $20,000, Tracy, of tax savings that he just didn't get good advice and good direction on. This is overlooked all the time. I see people writing checks out of their checkbook instead of giving money out of their IRAs. And so it's just one of the many strategies that people really need to consider and take advantage of.
Wow, that's great information. I had never heard that. Thanks so much, Eric. We hope this information has been useful to you. Now, next week, we will finish up our series of shows on a tax plan to beat the tax man in retirement with a look at estate planning and long-term healthcare needs. How do you leave your assets to family members when you're gone without burdening them with tax issues? And how can you best prepare for long-term healthcare so your loved ones won't have to pay the bills? Until then, for Eric Brenner and the entire Hilltop staff, I'm Tracy Capelman. Thanks for watching, and stay wealthy, everyone. We hope you found this discussion helpful today. Don't forget to like and subscribe to our channel for new content weekly.